Your money-making broadcast starts now. Good evening and welcome to your Market Close recap for Tuesday, May 5, 2026. Today's session delivered a story of two markets, with dramatic company-specific moves overshadowing a broadly positive day for the major indexes. The S&P 500 finished near record highs, extending the bull market's impressive run higher. The Nasdaq Composite hit a fresh all-time high, powered by a semiconductor-led rally that saw chip stocks surge across the board. The broader U.S. market, measured across our 103 stock average, gained 0.58%. Beneath these placid averages, however, some of the biggest names in technology, finance, and consumer goods made massive headlines. Oil prices slid from their earlier highs to settle near $105.23, with the oil tracking ETF tumbling, though diesel prices have now crossed the $5 mark, raising concerns about transportation costs and broader inflationary pressures. Let's break down the biggest stories that define today's trading session. The semiconductor surge powers Nasdaq to a record. Intel was without question the star of today's session, exploding 13.2% to close at $108.42. The once struggling chip giant is now worth more than Oracle, marking a stunning reversal of fortune as investors embrace Intel's turnaround narrative. Semiconductor earnings are firmly in focus, and Intel's massive move lifted the entire sector. Advanced micro devices surged 4% to $355.28, recovering from yesterday's 5.3% decline. Micron Technology jumped 6.3% to $576.45. Even Cisco Systems joined the rally, hitting a new all-time high of $94.44, underscoring the breadth of the semiconductor and network infrastructure trade. The Nasdaq's record close was powered almost entirely by this chip sector momentum, and the question now is whether this strength can sustain into the coming sessions. Big tech stumbles despite the rally. Not every technology name participated in today's celebration. Shopify, Canada's biggest technology company by market value, cratered 15% after issuing a disappointing Q2 outlook for both revenue and operating income. The e-commerce platform's stumble serves as a stark reminder that even high-growth companies face margin pressure in the current economic environment. Palantir Technologies fell 6.79% to $136.12, despite reporting record Q1 revenue. Wall Street is quibbling about valuation and profitability concerns, punishing the data analytics firm even as its fundamental business metrics improve. This divergence between strong results and negative price action is a hallmark of a market that is increasingly selective and demanding of clear profitability paths. Financial sector delivers a mixed picture. The financial sector had a busy day with several major stories moving stocks. PayPal reported better-than-expected earnings, but the new CEO's commentary during the earnings call sent the stock lower as investors parsed the leadership transition and strategic direction. Coinbase announced it is laying off 14% of its workforce, citing a new way of working driven by artificial intelligence. The crypto exchange's stock closed up 6.1% at $202.99, suggesting the market views the restructuring as a positive efficiency move rather than a sign of distress. In a significant development for the financial AI space, Anthropic is deepening its push into finance with the launch of 10 new AI agents designed for banks and insurers, backed by a $1.5 billion venture with Goldman Sachs and Blackstone. This deal highlights the accelerating integration of artificial intelligence into core financial services infrastructure. HSBC missed Q1 expectations, reporting £1 billion in unexpected credit losses, sending its shares lower in London trading. On a brighter note, American Express Global Business Travel agreed to a $6.3 billion take-private deal with Long Lake, highlighting continued private equity interest in the travel and corporate services sector. Energy, consumer, and industrial movers. Energy stocks faced headwinds as crude oil slid from its highs. The oil tracking ETF is tumbling, but diesel prices topping $5 provides a partial offset. United Parcel Service plunged 10.5%, a major decline for the logistics giant that likely reflects concerns about global trade volumes and elevated fuel costs eating into margins. AB InBev surprised to the upside, popping on a surprise sales surge that caught analysts completely off guard and demonstrating resilience in consumer staples. Blue Owl Capital shares surged on what the company described as 10 times gains from its SpaceX investment, showcasing the lucrative returns available in private markets for those with access. Nuclear stocks Cameco and BWX Technologies are testing buy points following their earnings reports, as the nuclear renaissance narrative continues to gain traction among energy investors looking beyond traditional oil and gas. Michael Burry made headlines by selling his GameStop position following Ryan Cohen's eBay bid, a move that signals shifting sentiment in the meme stock space. Stock picks for the week ahead. Let's turn to our stock recommendations for the week, drawing on the wisdom of investing legends to frame each opportunity. The legendary growth stock investor Phil Fisher would look at Intel's current trajectory and see a classic operational turnaround story. Fisher always emphasized investing in companies undergoing genuine transformation driven by innovation and execution, and Intel's 13% surge on strong semiconductor earnings validates that this is more than a temporary bounce. From a growth perspective, Intel at $108.42 represents a semiconductor value play in a sector that continues to expand as global chip demand rises. He would categorize this as a high-conviction growth investment for those willing to ride the semiconductor cycle with a company that is still early in its restructuring journey. The father of modern value investing, Ben Graham, would find himself drawn to Pfizer at $26.17. Trading at a modest valuation with a stable, defensive business model, Pfizer exemplifies the margin of safety that he preached throughout his career. In a market where many stocks trade at elevated multiples, Pfizer offers stability and meaningful downside protection for conservative portfolios. The stock barely moved today, down just 0.49%, and that stability is precisely the point. This is a classic defensive value pick, ideal for investors seeking exposure to the pharmaceutical sector with limited downside risk and a steady dividend. The legendary Fidelity Fund manager Peter Lynch would appreciate the story behind Cisco Systems hitting a new all-time high at $94.44. Lynch famously advised investors to buy what they know and understand, and Cisco's networking infrastructure hardware sits at the heart of the modern internet. At a fresh record high, Cisco represents the kind of steady compounder that he favored throughout his career. It is not flashy, but it grows consistently as enterprise network demand expands with AI, cloud computing, and data center buildouts. Lynch would classify this as a pick, balancing established market leadership with steady growth tailwinds that extend well into the future. The world's leading innovation-focused fund manager, Cathie Wood, would see SoFi Technologies at $16.14 as a compelling opportunity in the financial technology disruption story. However, any investor considering SoFi should understand an important context about the company's loan platform business, known as LPB. SoFi's loan platform business allows it to originate and sell loans without holding them on its balance sheet, reducing capital requirements while generating fee income. This model is key to understanding SoFi's path to sustainable profitability and its competitive advantage against traditional banks burdened with legacy infrastructure. With the stock stable and the fintech sector maturing toward profitability, she sees SoFi as a growth story that could compound significantly as digital banking adoption accelerates among younger demographics. The pioneer of global contrarian investing, John Templeton, would cast his eye on the broader market and find opportunity in today's sell-offs. He famously advised buying when others are selling in a panic, and today's dramatic declines in Shopify, Palantir, and UPS would catch his attention as potential opportunities. He would remind us that the best time to accumulate quality companies is often when they fall on non-fundamental concerns or temporary sentiment shifts, a contrarian approach that has generated enormous wealth over many market cycles. He would counsel patience and a global perspective, noting that the semiconductor strength in the U.S. masks a world economy with significant divergences and opportunities. As the closing bell sounds on May 5, 2026, this market continues to reward patience, selectivity, and a clear investment framework. The Nasdaq sits at a record high, semiconductors are leading the charge, and the bull market powered higher without a single megacap stock driving the action. But beneath the surface, individual stock stories tell a more nuanced tale of winners and losers. Intel's explosive move, Palantir's frustrating decline, and the steady strength of defensive names like Pfizer all remind us that this is a stock picker's market. Oil's slide from highs and diesel's breach of $5 bear watching as potential headwinds for the broader economy. Tonight, we lean on the wisdom of investing legends to navigate this complex environment. He would ride the Intel turnaround with confidence. He would find safety in Pfizer's margin of safety. He would stick with Cisco's steady compounding story. She would back SoFi's fintech disruption with LPB context in mind. And he would scan the wreckage of today's losers for contrarian bargains. Remember, the best investment strategies are built on frameworks that survive any market environment. I'm Chloe. See you at 7 a.m. Eastern for shorts. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.